Hey everyone, we're going to go ahead and get started. Welcome to the Beacon Financial Strategies Financial Planning and Market Update. My name is Nick Faulkner and I serve as the Portfolio Administrator here at Beacon. This webinar is designed to be informative in nature and to not recommend a strategy or give advice. There will be a Q&A box at the bottom of your screen. If you have any questions, just want to type in there and chip in there and we'll get to that. Keep in mind, we have tons of resources on our website at beaconfinancialstrategies.com, such as other web presentations, articles, and even our podcast, Finance in a Flash. Also, this webinar will be recorded and posted on our website as soon as possible if you're unable to stay for the whole time or if you want someone else to watch it as well. At this point, I want to turn it over to Chip. Chip and Aaron, the hosts of this webinar, and they're the founders of Beacon Financial Strategies. And Chip, take it away.
Hey, thank you so much, Nick, and thank you everyone for taking time out of your day. Hopefully we will be around to provide some good and relevant advice. Hopefully you'll get a couple of takeaways. A few things, because we're going to be talking about the investment markets in general. We're not really intending to give direct advice, so just be aware of that. We're talking about things in a general nature. Anything that you do from an investment standpoint should actually be consistent with your own personal risk profile and long-term financial plan. Also, keep in mind that portfolio returns and risk go hand in hand. So ideally, when you take more risk, you should have greater returns over the long run. That doesn't always hold true in the short term, but it's something to keep in mind as we navigate this presentation. Also, research has shown that a globally diversified portfolio is a great way to go about investing for the long term. It just shows that portfolios benefit tremendously from this diversified approach, as well as keeping frictional cost low. And what I mean by that is things like tax efficiency. We want tax efficiency to be high, and we also want to utilize investments that have a very low internal cost structure. All right, so as we talk about the financial markets this year, I kind of want to show you, and these are all benchmarks here on the left. So you can see the Dow Jones, the S&P, smaller companies, international, and then some bond investments. And I would like you to think in your mind, how do you think each of these different asset classes have performed this year? So now that you have that in your mind, let's take a look at the results. So for 2020, this is what it looks like. So the Dow is down. The S&P has had a reasonably good year so far. Smaller companies, international companies, though, have not done very well. It's kind of a mixed bag. It's also interesting to see that year to date, at least, government bonds, U.S. Treasuries, have performed quite well. And this is an intermediate term bond benchmark. And that's an odd, if you think about it, that's kind of odd, right? You've got your high risk investments that have performed as kind of a mixed bag. And then you have your more conservative investments that have done very well in a very low interest rate environment. And so that's just kind of an odd dynamic to think about. But it kind of plays into the to 2020 in general. I think if we stretch it out and look at the long term, though, you can kind of see here that things have normalized a little bit. I think the long term averages for stocks are somewhere in the neighborhood of 10% or so. And over the last 10 years, stocks have done pretty well. Bonds, again, your lower risk investment has performed as you would think that they would perform. Basically, maybe a little bit right around inflation. The one notable exception here is international stocks, and coming out of the Great Recession and dealing with Brexit and all those issues, that's still materializing. And so, if we look back, then you can tell that investors have not been rewarded for accepting that risk. Now, keep in mind that behind this international benchmark, there are some really excellent global companies. And so, those companies are benefiting from, a global advancement in wealth and all those dynamics that propel stocks forward. So this is a past looking chart, but we always have to be forward looking. And so that's something just to kind of keep in mind. I also want to review with you really how scary and volatile this year has been. And you can see here that, and this is the blue line is the S&P 500. The gray line is the EFI index, which is an international benchmark. And the orange is the Russell 2000, which is a small cap market index. And you can see here from January to March 23rd, it was basically a free fall. I think that we all went through a lot of stress during this period of time as the pandemic started to emerge, and some of the details and uncertainty surrounding that really played and weighed on the market. And so, but about on March 23rd, that's kind of the point in time where we saw a significant snapback. And I think that this is the way market corrections oftentimes happen. It happens abruptly and quickly, but no one knows when it's going to turn. And so, in order to participate in those great long-term returns that we saw on the screen earlier, you really have to be willing and able to endure these, scary sorts of declines. And so these are equity market performance, but you can see here the Russell 2000 of small cap index really advanced quite a bit over that period of time. And then you can see here, continuing on through October, that advancement has continued. And so I think this is an interesting little check mark to take a look at, but it is indicative of how things perform, especially during periods of volatility. Now, one of the things I want to talk about with you guys, and if you have been getting our email newsletters and looking at the presentations and some of our podcasts and things that we're doing, we are talking a lot about how indexes are comprised. And I think this is a great graphic that shows that. And so the Dow Jones Industrial Average represents about 15% of the total global market in terms of tradable stocks, okay? But the Dow is only 30 stocks. Of the 30 stocks, the top 5 stocks constitute about 31% of this index's weighting, okay? So if any one of these companies runs into a soft patch or something negative impacts the performance, then that's going to have a huge impact on the returns of the Dow. Now, these are all indexes that the media quotes, and you see these even in our newsletters and things. The NASDAQ, now you'll notice here, the NASDAQ has many more stocks, about almost 2,800 stocks are in the NASDAQ at this point. And of those 2,700, the top 5 constitute 41% of the index, okay? So keep in mind, and those companies, Apple, Microsoft, Amazon, Google, and Facebook are great global brands, okay? They have done really well over, really for a long time, okay? But that's 41% of this benchmark. And so, I just want people to be careful and understand what they're hearing when benchmarks are quoted. Even the S&P 500. Okay, the S&P 500 consists of 500 stocks. The top 5 stocks, Apple, Microsoft, Amazon, Google, again, and Facebook, represent about 24%. This is a 5 stocks out of 400, or 5 stocks out of 500 stocks represent 24% of that index. It's just a huge weighting. If any one of these stocks or multiple of these stocks runs into a problem, it's going to have a big impact on the index itself. If we expand out to the total market index and even to the global market, there are 14,700 total stocks that's tradable, okay? But of those, even in the total global market, Apple, Microsoft, Amazon, Google, and Facebook represent 11%. So still it's diversified. Now we're getting into diversified types of indexes. And, there's a few of these, you could actually invest in these with an ETF, but still, it's just important to realize that what constitutes an index. And the next slide here, I want to show you because I think we want to hone in a little bit and pick on the S&P 500. And you can see here, year to date, the S&P 500, if you look at the index performance itself, is up about 5.6%. Now, over the last 1 year, it's done really well. And if you think about what's going on right now, the uncertainty around the pandemic, the recession that we are seeing, the numbers or GDP has declined actually. And so things are not, they really don't seem great. So why is this index doing well? Well, let's look at the top 5 stocks that I mentioned a minute ago. Apple, Amazon, Microsoft, Facebook, and Alphabet or Google. If you look at those 5 stocks that represents 24% of the total of the S&P 500, if we take the average yearly performance of those stocks, you see a 40% return year to date and a 62% return over the last year. These companies have performed exceptionally well during the pandemic, okay? And so some of these, I mean, I can tell you Amazon for sure has done really well. I mean, people are at home, they're ordering more, and you know, it's justified in a lot of ways. Just people are demanding more delivery. Facebook and Alphabet, you know, or Google, I mean, they're benefiting from the fact that it's an election cycle and advertisers are using that and that sort of thing. So, but these are 5 stocks of the S&P 500. Well, what about the other 495 stocks? How have they performed? Okay, so we have seen negative performance there for the year to date period if we take the average of the other 495 stocks in the index. So my advice is here that to keep in mind that if you have a diversified portfolio, you're not going to see, you know, greatly huge outsized returns. Now, if you're have gotten lucky and you have a portfolio that has a lot of exposure to a particular index or especially these 4 or 5 companies, then, you know, you need to scrutinize your portfolio and think, you know, is this a good way to invest? Because, you know, the vast majority of companies out there aren't performing nearly as well as these 5 leading stocks. All right. So that's good. I want to think, and a lot of the questions we've been getting now involves the election. Okay. It is a interesting period of time here. I know this is a very contentious election cycle, and but what happens to the markets during election years? Okay, and so since 1926, there have been 23 presidential election years, and of those 23, 19 years have been positive. Okay, so by and large, the markets have performed at least on a positive standpoint for 19 of the 23 years. Of the 4 years here, we can take a look at what's going on. And you can see in each of the 4 years where we've seen a negative performance during an election cycle, a presidential election cycle, you can see and recall that, you know, it's not really the election itself that is causing these negative returns. It's more of external factors. It's the economy. It's, you know, you're coming out of a Great Depression. It's build up for World War II and the uncertainty around the future of that. It's, you know, the tech bust. And it's the Great Recession. It's other issues that are really impacting the overall performance of the markets, not necessarily the fact that it's an election year. Okay. So if we look at presidential administrations, right? So you can kind of look back over the last 10 or so administrations, and you can see, you know, by and large, we see positive performance throughout. It doesn't really matter the administration, whether they're Democrat or Republican. It doesn't really matter. By and large, we see positive performance. You know, the exception here recently, I guess, is George W. Bush. But if you look at the time of this, his administration kind of started right after the tech bubble burst, and then also ended around the Great Recession. And so it's not necessarily the presidential candidate or the president who's in office at the time in the White House. It's simply a matter of what's going on in the economy, the uncertainty that surrounds that. And this next chart kind of reiterates that, right? So you can see the red segments of the graph are Republican president. Republican is in the White House. The blue is a Democrat is in the White House. And you can kind of see there's just an upward trend. Now there's bumps along the way everywhere. I mean, this is Black Monday, 1987, with Reagan's presidency. There's all kinds, there's 9/11 that happens. There's all kinds of things that are going on. There's bumps in the road, but by and large, there's this upward trend, irregardless of who is in office. What about Congress? I think this is an interesting graph again to show, because there's Republican-controlled Congress, there's Democratic-controlled Congress, and then there's mixed. And so you can kind of see here that irregardless of what happens in Congress, by and large, the markets are not beholden to decisions that are made during that period. It's driven by profitability of companies and growth in the economy and that sort of thing. So what should people do? So I think that we are getting a lot of questions. What should I do now? What are some decisions that we need to make? What should we do in the event that a particular candidate wins or loses, or should we take action? And really, I think that it's reasonable to expect more volatility. I think that the election, this is a strange election year, right? We've got tons of absentee voters. We've got, it's just a highly contentious election cycle. So there's going to likely be volatility and uncertainty, just as a natural part of what's going on. But my suggestion is to focus on those things that we can control. We can't control what's going to happen in the market in the next weeks, days, weeks, and even the next year. But we do know that if you maintain a diversified approach in your portfolio that is consistent with your risk profile and your cash flow needs, in other words, if your investment strategy is grounded in your financial plan, then it's no need to worry about all of this noise, okay? Take advantage of any planning opportunities that can create a benefit to you, right? And we're gonna hit on a couple of those ideas here in a few minutes. But those are the things that we really are suggesting you do. Not really alter your portfolio, your allocation, or make any major changes there. Just really make sure that your portfolio is based on your own personal circumstances and go forward, okay? At this point, I want to turn it over to Erin and have her speak to you guys a little bit about financial planning options.
Thank you, Chip. That was great. We appreciate the good advice on the investments and what's going on there. So I wanted to take a minute and spend a little time with you guys today to talk about financial planning opportunities. Specifically, I thought we would start with tax planning because it's the end of the year, and that's what we tend to do at the end of the year. So just wanted to think for a second about what we're thinking about. So first off, I just wanted to point out that there's a good chance that income taxes are going to rise in the future. And that's really, in my opinion, irregardless of elections or who's elected or anything like that. The reason is that the current tax law, just the way it's set up for most individuals, for all individuals, basically is set to expire in 2026. And so we know, even if another tax law is not passed, that the current tax brackets are going to expire. So we're going to actually revert back to the 2017 tax rates at that point. And so we point this out because we think it means that it's a good year to think about accelerating income. And so this is something we don't usually talk about when we think about taxes. We always think about deferring taxes. And now what we're saying is, no, actually, maybe it's a good time to think about accelerating income. And so I wanted to take a second to look at this graph. Basically, if we know that in 2026, the tax brackets are going to revert back to 2017 brackets, what does that mean? And so this chart, if you can see here, the first little bar graph is 2020, the tax brackets, if you're married. And then beside that is the 2017 if you're married. So that's what it'll be in 2026. So if you look just at the married brackets and you think, oh, you know, I've got taxable income of $150,000, then you're likely right here at the top of the 22% tax bracket. Well, you kind of go out here, you might be actually in the 28% tax bracket in the future. So that's why we're thinking about right now, it might be a good time to accelerate the income, pay the taxes at 22%, because in the future, you might be at 28% with the exact same income. The same thing for single. Your eye kind of goes to this 35% bracket for single. I mean, that's a huge area, but it's anywhere from a little over 200,000 up to 500,000 is right now in the 35%. But you can see if you go forward, it's probably 35 to even 39%. So it's something to think about. It's to think about the lower tax brackets. I always pay a lot more attention to these lower ones, the 12 and the 15. They're almost identical. You're currently in the 12% bracket. It's a very good certainty that in the future you'll be in the 15% bracket. So that's why we're thinking a little bit about accelerating income in 2020. And so for a lot of people, what that means is we're thinking about Roth conversions. And so I just wanted to go over real quickly what a Roth conversion is in case you've never heard of that. Most of you guys have heard of it because we talk about it a lot here, but basically we're going to take money from your existing IRA account and move it into your Roth IRA. It's important to note that you do pay taxes on that conversion. So if you're taking money out of your IRA, you have to pay taxes on it. It's tax deferred and you had a tax deduction going in, so you're going to have to pay taxes on it as the money comes back out. But you immediately move it to a Roth and then you're never taxed on that money again. And so that is what we're talking about. It's important to say, great, let's take it out at that 12% bracket and we never have to pay taxes on it again. And we're saving because in the future, we think we're going to be in the 15% bracket. So that's the big thing there. Also with a Roth IRA, you don't have to take required minimum distributions. That's important because once you're age 72, you have to take money out of your IRA, out of your 401k, out of your 403b. The IRS is saying you have to take money out and they tell you exactly how much. Well, you're going to have to pay taxes on it. So if you don't have to take a required minimum distribution from a Roth, then that's going to also save you in the future. So that's the other reason why we like those Roth IRAs. And lastly, beneficiaries don't have to pay taxes on Roth IRAs when they inherit it. So if you leave a Roth IRA to your children or your grandchildren, they're going to have to take the money out eventually, but they don't have to pay income taxes on it. So that's a really positive thing for your future heirs as well. Another way that we're looking to accelerate income this year is thinking about tax gain harvesting. So a lot of times when we're talking about taxes, again, we're talking about deferring and lowering our taxes. But this year, we're really talking about accelerating income. And so what we're thinking about there is let's take advantage of the capital gains rate. So the capital gains rate for investments, when you sell it, for most people is at 15%. However, if you're in that lower bracket, in that 12% bracket, you're actually in the 0% capital gains rate. I mean, so that is amazing. So if we know you're in the 12% bracket or lower, and you have an investment that's at a gain, we could sell it and really pay 0%, which is amazing. So that's something that we're going to be looking to do for some people here at the end of the year if there are investments that need to be sold. I just want to point out this is not for your IRAs, it's not for your Roths, it's not for your 401ks. It's actually for those taxable or personal brokerage accounts that we'd be looking to kind of take advantage of this opportunity. So that's something that we are looking at for a lot of people. We may be using that to offset losses. So Chip pointed out earlier that graph of how things went down. We may have sold some things at a loss earlier in the year. We may not have, but if we did sell some losses, we could offset these gains with losses and even out the taxes that way as well. So there's just a lot of little things that we're looking at in those brokerage accounts. So we wanted to point that out as well. Another planning opportunity that we're thinking about for a lot of people is mortgage refinancing. I know that you guys are pretty aware that interest rates are super low. And so when that happens, mortgage interest rates also are lowered. So it may be a good time to be looking, especially if you've got a mortgage, hey, is it a good time to lock into a lower, and ideally you'd lock into a fixed rate. I hear a lot of our clients are telling me that they're getting, 3%. I've even seen lower than 3%. I took a peek a couple of days ago and it was at 2.5 for, a 15-year or 20-year loan. So there's a lot of benefit to thinking about that. You could lower your overall interest over the life of your loan by doing this. So if you were going from a 4% to a 2.5 or 3%, you'd be lowering your overall interest paid over the life of the loan. You could also be lowering your monthly payment depending on kind of what your term was. And you may actually reduce the length of time till you pay off your mortgage. And so all of that makes a lot of sense. I don't want everybody to go into this blindly. So if this is something that you're interested in and you're like, hey, should I think about a 30-year or a 20-year or 10-year, then go ahead and reach out to us. We're happy to kind of analyze that and give you some information and make you think through all of those different decisions. So something else that is on my mind this year is estate planning. And we talk a little bit about this when we have meetings with you guys, but we always want to make sure that you're checking your beneficiaries on your IRAs, your Roth IRAs, your life insurance, your 401k plan, your 403b, your pensions, anything out there that you can have a beneficiary on. I really want you to go in and just double check that it's who you thought it was and that it's who you still want it to be. A reason why I'm concerned about this year is because we had the Secure Act that was passed, I guess, at the end of 2018, 2019. And what that did is it got rid of the got rid of the stretch IRA. And now there's a 10-year rule for non-spousal beneficiaries. So you may be asking, what does that even mean? Well, let's just say you have $1 million IRA and you have your children are the beneficiary. Well, your children are going to have to take distributions from that IRA over 10 years. Now, they don't have to take it, every year for 10 years. They could take it all at once, but they do have to take the whole thing out within 10 years. And so that is huge. And what that means is they're not allowed to stretch it over their lifetime. So that used to be the rule. And now the rule is this whole 10-year thing. Well, in my mind, that means that Roth conversions could make a lot of sense. And again, we're going back to that whole accelerating income in this current year, but it may make a lot of sense if your heirs are in a higher tax bracket and then now they're going to have 10 years to take that money out and pay the taxes on it. It could make a lot of sense. And so if we kind of go back to that graph that we looked at before, if you're in one of the lower brackets, but your children are in a higher bracket, even now or in the future, then it could make a lot of sense to go ahead and prepay taxes on your IRA, move money to a Roth, and then they inherit the Roth. They will still have to take out the Roth IRA over 10 years, but they don't have to pay taxes on the Roth. And so that's the big reason why we're looking at that.
Hey, Aaron, one quick question for you there.
Yeah.
We got a question that says, is there an income limit or is there a limit that can be converted from a Roth?
Okay, yeah.
From an IRA to a Roth?
That's a great question. So there is no income limit on the amount you can convert to a Roth. If you think about it, the IRS would love it if you would take your whole IRA out, pay all the taxes, and pay all the way up to this 37% tax bracket. They would love it, right? They're getting all that income in this current year. But typically, I don't tend to look at it like that. I tend to look at it at doing some of the lower brackets and maximizing those and trying to minimize the taxes there. But there is no limit, so you can take out as much as you wanted to. It's just kind of your threshold for paying on how much you want to pay in taxes. So,
and one other question here, I think it's a good point, because someone asked, could executing a Roth conversion now lower my RMDs in the future?
Yeah, and it does. And that's because the way the required minimum distributions work with IRAs is it's calculated on the balance of the IRA. And so if you've taken money out ahead of time, then it lowers that balance down and therefore your required minimum distributions in the future will be lower just based on that. So, all right. So in thinking about estate as well, there's a couple of other things I just wanted to quickly point out. I think it might be a good time for everyone to review their estate documents. We've spent some time this year going through estate documents, and we're still kind of going through them. But it may be a good time to at least take a peek at them and see if they need to be updated. Specifically, some of the things that I'm thinking about are your powers of attorney and making sure that those are up to date, because that's an important thing to think about. The healthcare powers, that is one that has really come out a lot in the news because people with COVID are not able to sometimes make their own healthcare decisions. And so I want everyone to go and check and see who they've named as their healthcare power of attorney, because I want to make sure that it's the right person. Is this person going to be able to make healthcare decisions on your behalf? Is that the person you want making those decisions? And have a discussion with them about what you want. Usually we write down what we want in something called a living will. Some of the things that have come out again because of COVID this year is, do you want to be intubated or kept on life support? And some people have had that discussion in the past and have said to their loved ones, hey, I really don't want to be kept on life support. I don't want to be intubated. But based on what's going on with the current pandemic, you may have a little bit of a different opinion. You may say, hey, I really don't want to be kept on life support, except in the case of COVID. And then I do want to be. So it's something to kind of have a discussion about and potentially update those documents so that your healthcare power of attorney knows and understands about what you're thinking there. The other thing to think about is just the durable power of attorney, which that's the person who can make financial decisions on your behalf. Make sure that it's the person that you want it to be, that you've had a discussion with them, they understand, kind of your thoughts there. We want to make sure that everyone's prepared, and hopefully they won't come into play anytime soon, but we want to make sure everybody's prepared in case it happens. Something I just thought I would throw in here just to kind of talk about real quick is a legislative update. I'm not necessarily a lobbyist or anything, but I do pay attention to this stuff. And most recently I have watched, I think, way more town halls from specifically the AICPA, and they've been giving a lot of information to the CPA community about what's going on in the legislature. So a big question that I think a lot of my clients have asked is, will there be another federal stimulus package? And what I'm hearing from the powers that be is that there will be another stimulus package. There will be another law that will come out. And it's just a question of when and not if. So it will happen, but we just don't know when. I think probably a lot of you guys are aware that there are several different laws that are being passed around the Senate and the House. And we just don't know if they will be voting on it, prior to the election, between the election in January, or even after January. But there is some expectation there that there would be some kind of other stimulus package. As far as what's going to be included, there's some talk that there'll be some small business bailout, and then specifically around small businesses that have had significant revenue drops. And so it won't be like the PPP loan that was passed earlier this year, but more like you'll have to qualify based on your revenue decreasing over a period of time. There is some talk that there would be an individual stimulus similar to what they sent out earlier this year, where they mailed everybody a check or put money in your bank account. We're not sure how much that would be, obviously, but there is some talk about that. They are discussing unemployment extension. Specifically, I know that they gave, I think, $600 a week extra earlier in the year. That has run out, but I think there's some hope and some thought that there would be some more unemployment extension in there. And one that I keep listening to, and I have not heard this yet, but that there could be 2021 required minimum distribution relief. In other words, in 2020, most people know that you do not have to take a required minimum distribution. Will that be extended into 2021? As of right now, there's nothing in the law that says that it will be extended there, but I think that there's a chance that would pass next year, depending on the state of the economy and so forth. So just some things to think about. Finally, I just wanted to take a second and talk about kind of what we've learned about this year. This has been a challenging year for pretty much everybody I know. There's not one person I think that hasn't been affected by the pandemic, the economy, the worry. Our kids are being educated at home a lot of times. And so there's a lot going on, and it's been challenging for everybody. And so I just wanted to take a moment of reflection, because I think it does play into our financial planning and our thoughts in the future, to think about what has changed in your life. What kind of goal changes have you been thinking about? What's going on with you? What have you kind of focused on this year? And so I just wanted to take a second for everyone to kind of think about that, because there's a chance that the current challenges and the things that we have faced in 2020 may have you rethinking your current goals. It may not, but there are people out there I know that are saying, I think I'm ready to retire earlier than I would have thought, because I really want to spend that time with my family. Or they may be thinking, I want to travel more when everything opens up to travel more. Or they may be thinking, what's really important is me spending time with my grandchildren, or leaving a legacy for them. And so that may be something that's going on with you. And so, if you have those changes, then there may be a chance that we need to reassess your entire financial plan to make sure that all those new goals and the things that have changed in your life are being reflected. So just some things that I wanted to kind of plant the seed with. And if you're in that category and you've made any kind of thought-provoking changes, then reach out to us and let us know, so we can make sure that that's kind of in your financial plan. All right, so that kind of concludes what I wanted to say. So I guess the next part is to just see if there are any more questions out there. And Chip, I know you've been looking at the Q&A, so
we have one question, and the question is there a time required to keep an IRA with the broker before converting to a Roth? And the answer to that question is no. There's no time stipulation that you have to keep money in an IRA prior to converting it to a Roth. Keep in mind, though, that you may not want to convert the entire balance of the IRA. You may want to piecemeal it a little bit, which is kind of what Aaron was talking about before. But and there may also be the depending on the broker that you are using, there may be fees assessed with that type of transaction. Just depends on the broker. That's all specific to the custodian that you're using. So there is no reason or requirement to hold an IRA prior to converting it into a Roth IRA. Is it all possible that 2021 tax rates can change during 2021? And I think anything's possible, right, Aaron?
Yeah, I would say absolutely. We have definitely seen that happen. So that's why I think a lot of people are saying 2020 is the year to be thinking through this stuff, because I don't think we're going to see anything that would change 2020's tax rates. But I know for a fact that in my career, we've had tax laws come down at, December 18th or something, and it's retroactive January 1st of that year. So I think that anything's possible. They definitely can do things retroactive. And I think that's potentially why 2020 seems like it's the year when it would make the most sense to do, any kind of income acceleration.
I think it puts a lot of pressure on the taxpayer and their advisors. I think we all feel like, we have to be on our toes for this. This year has been, literally, I think Aaron and I, especially Aaron, has been on weekly conference, sometimes multiple a week with the AICPA. Just they're going through, what's coming down the pipe, what's the conversation looking like, what directions are things headed, how are things going to be considered this year, how are things going to materialize next year. And it just seems like a lot of chaos. And so we are working awful hard behind the scenes to make sure that we are abreast of all of these things and ready to identify actions that we can take should they arise. And it's been a one for the books. I'll just say that, right, Aaron?
That's right. It's been a crazy year. I was not kidding when I said it. It's been a challenging year for everyone.
Yeah, no doubt. All right, that's all the questions that I see there. So if we advance to the next slide, I think that we have a few parting thoughts. And, one of the things that I'm reminded of is just manage the information that you consume. Because I can tell you the way that social media is structured, and it's very targeted. So, just be careful about those things that you consume, because it can impact your really your peace of mind and your life. And so we like to maintain this optimistic focus and focus on the things that we can control. And I'll say that we have made a huge attempt this year to be a source of good and reliable information to our clients. And, we've done multiple web presentations. We do podcasts that every other week we do articles on things that we're seeing. And so we're trying to be that resource that you can depend on, to provide a reasonable outlook and a realistic outlook. If you just go to our website, beaconfinancialstrategies.com, and go under the Insights tab, you'll see a lot of that content that we have. And again, focus on the things that you can control and ignore the rest. That's the best part. It's so liberating when you can do that. And, it's nothing that is going on in the world we can control. We do have that beautiful right to vote, and we hope that you exercise that right. But other than that, there's nothing that we can control. Just ignore those things. All right. Well, that is all for today. We really appreciate you guys taking the time out to listen to this webinar, and hope that you got a nugget or two out of it. And but always feel free to contact us if you have any follow-up questions. We do plan on posting the recording of this presentation on our website. It may be a few days or so before we can make that happen, but that's our expectation. But in the meantime, you guys stay well and have a great rest of your week.